Good morning, everybody, and you are going to have about half an hour joint presentation from a research group on covering the macro and fixed income and equity markets. So we kick off, as is the wont, with the macro side. So here we have the IMF latest view, the output data from the IMF. Well, where we've got to is that these figures again have been trimmed downwards. This is October forecast. This is a quarterly event, so we're slightly lower this time around. Probably one or two things to point out is on the Eurozone, of course, since Eurozone and Japan equally, as we all know, they're in extended phases of monetary easing, and there's going to be more of it, especially Eurozone. It now appears that the QE program is going to be extended either in size or in eligible assets or in depth or a combination of the above. The China figure, everyone wants to talk about China. The China figure, the IMF figure, they had their 6.8% for the current year growth. They didn't change it this time because they changed it before. And what you've had since then, of course, is that the Q3 figure came out, GDP China, first two quarters 7%, third quarter 6.9%. But I think, what people should focus on is less the 10 basis point decline in growth, but the fact that the Chinese economy is remodeling. And the reason we're all interested in China is because of its demand for commodities, oil, gold, whatever. Now, there's far greater impact on demand for those commodities from the remodeling, because if we're moving from an economy that's driven by investment to one that's driven by consumption, that probably tells you need far less steel, oil, gold, diamonds, whatever. Well, not diamonds, actually, for the process. The other point to bring out here is on the US. Well, the US is obviously the fastest growing economy of the so-called Western world, and as we all know, we're at a critical point in the Fed process, which we'll come back to very briefly. Right, this is a brief slide, Nigeria and China. So what's in it for us, for Nigeria? Well, on the surface, not a huge amount, because exports to China from Nigeria are limited. A minuscule percentage. We all know that the main oil export markets are elsewhere. We also know that on the infrastructure side, China has not been rebuilding the infrastructure of Nigeria as it has done in, for example, Angola, Gabon, Zambia, countless other places. And we also know on the financing side, yes, of course, Exim Bank is now a significant, well, in as much as Nigeria's public external debt is significant, within that, Exim Bank has become significant. But I don't see this is going to stop. But the greatest, what we're looking out for China, Nigeria, of course, it goes back to the remodeling of the economy and the demand for all commodity prices. Right, this is the Nigerian growth data. It goes up to second quarter. The second quarter figures were the worst under the new national accounts, rebased national accounts. Worst for oil, for GDP, 2.4% year on year. Worst for non-oil, 3.5% year on year. What do we have here? Well, classic squeezing of demand, plus to a lesser extent, excuse me, to a lesser extent, issues of insecurity. Where basically our view going forward is that well, of course we're now in Q4, of course, but Q3 probably no better than Q2, if at all, and Q4 maybe marginally better, maybe a bit of fiscal support, but nothing to get very excited about. Now, this is the big issue, which is the new administration, which the MD was referring to. So what we have, of course, we're waiting for the ministers, we all know that. Just to say very briefly, I think that, of course, we are waiting patiently, or not so patiently, but I think to bear in mind is actually civil servants run economies across the world, in any way you want to mention. It's not a specific point to Nigeria by any means. So the fact you don't have ministers doesn't actually mean that the domestic world comes to an end. What it does mean, of course, is that a number of policy decisions which are for ministers to take are not taken. So, of course, we're waiting for the ministers to be appointed, waiting for them to declare some policies where there's a vacuum. What are we going to expect? Well, we're not in the business of crystal ball gazing, but I think 2 points are worth making. The first one, of course, is that the victorious coalition in the elections is a coalition, which by definition means it has different elements in it, and those different elements have different preferences. That's the first point to make. And the second point is that I think the administration, the people around the new president, or not so new, have made it quite clear that they're not going to just overturn everything that has been done previously, because that takes all the time. They may overturn some things, pursue some individuals, but it won't be a blanket policy, because otherwise it becomes all-consuming, which is what happened with the Yar'Adua administration, arguably. Right, on the debt, this is the debt burden, and the point to make here is that there's quite a lot of room, actually, for borrowing, but borrowing on concessional basis. The debt-stock ratio, which is a favorite of lots of people, Nigeria has an exemplary one, either for the federal government debt, which would be about 11% of GDP, or if you include everything else which you could conceivably consider to be public sector, you might get to 25%. But either way, it's a very strong ratio. The recent bailout of the state governments has just merely shifted the balance within the Venn diagram, if you like. So basically, what was non-federal government debt has become federal government debt because the loans have been converted into FGN long bonds. The challenge, of course, is on the debt service side, which is why the priority is to go for concessional borrowing. Debt service ratio, debt service has been growing very strongly, domestic overwhelmingly. Current account, now we're going to accelerate for this part of the short presentation. On the current account here, well, what you have predictably, of course, you have Nigeria going into deficit on the current account. It's pretty obvious. Fourth quarter 2014, first quarter 2015, doubtless second, third, and fourth as well. Of course, because the oil revenues plummet, and the oil revenues are 95% of merchandise exports. So obviously you go into deficit. However, we think that the deficit is going to remain manageable. The reason we say that is because of import compression. Import compression because of lower household and lower household private demand. Also import compression because of the administrative measures, such as the famous 41 items on the circular from the governor from the CBN in June. Exchange rate. I mean, a lot of people are fixated on this, so we'll be very quick. Well, the point is, of course, is that the authorities favor a managed rate. We all know that. Market forces, especially, or market analysts, especially outside the country, are getting very indignant and saying this is quite wrong, you have to devalue for a whole variety of reasons. Our personal view is that, well, there are two reasons you devalue, two scenarios under which you devalue. The first one, of course, is that the market obliges you to, which happened twice already under this governor, once under his predecessor, Mr. Sanusi. The other reason you devalue is you think it's a good thing per se. Well, the authorities aren't at the second stage quite clearly yet. So they're at the first stage. They only do if they absolutely have to. Now, some people are even suggesting that the incumbent, the governor, actually his ideal for exchange rate arrangement is not managed but fixed. But that's sort of hearsay. So our view is that it will come. Perhaps it won't come before the end of this year. Perhaps it'll come in the new year, but it'll come due to market forces. So we're in the business of providing forecasts. We said in June, 215 at the end of the year. Let's see.